I know the chart's a little bit small there with the numbers, but just showing you kind of, Christia had touched on this. The markets are pretty similar, and even across the United States as a whole. I mean, inventory's on the lower side and demand's more on that higher side. But on this, you're just going to see that within the past 3 to 4 years, right now in 2021, it's that bottom line where you see the arrow. That's where the current inventory in Orange County is, which is just over 2,000 homes on the current market. You can see all the other years at this point in time were obviously much higher. If you want to go to the next one. And then, so that was in terms of the supply, so homes that are on the market currently up for sale. Now this would be in terms of the demand. So you can see where, again, in past 3 to 4 years, the demand may be a little bit similar. In other years, it's been a lot lower. But again, in 2021, at this point where we are here in the middle of June, it's the highest it's been within the past 4 years or so. So again, that's what's driving those prices up, not only in Inland Empire, but also in Orange County and just across the board in general as well. And then this chart, so I wanted to touch on this really quick. Ron, if you want to jump in on this, you can. But as you can see, so this is basically just taking back from 1980 up until now in 2021. You can see on the first column, which is the average 30-year interest rate. Now this, keep in mind, is for a primary residence. So for obviously investors, if you're looking to, or landlords looking to invest on a rental property, interest rates might be, a little bit higher, not by much. But anyhow, you can just see also in the second column, the median sales price in Orange County, and then the income, and then as well as the payment of the percent of the income. So 1980, Ron, I know it was rough back then, but you were still selling homes, is that right?
Yes, I was. And in fact, in 1982, that interest rate went as high as 17.5%. We were closing first mortgages on. What's really important to point out here in the right-hand column where you see the 55%, that's 55% of a person's income was going towards housing. At 17.5, it was close to 70%. Okay, so it was absolutely amazing. Prime was 21.5 back then. And so, yes, I'm dating myself a couple years, I guess. But at the end of the day, we were still selling properties. And when we were doing interest rates of 13, 14%, we had rents coming in at $400 or $500. That's what the rent was and stuff. But continue on, Tyler, down to 2021 there.
Yeah, no, appreciate it. Well, it's not called aging yourself. It's just you have a lot of knowledge, right? So for 2021, again, for primary residence right now, it's about 3% plus or minus for your interest rate. And as you can see for OC specifically, a whopping 1.1 million for the average or median price sales for a detached single family home. You can look at that as good news. We look at it as good news, as Chrissy alluded to. Even if you're an investor, the appreciation has gone up dramatically. So you have benefited from that as owning property, whether it's a rental or your own. And then if we can go to the last slide here. So this is just to kind of wrap things up for Orange County market. So expected market time as of right now, this was about a week ago, for homes priced between under 750,000, it's just over 2 weeks, which is crazy. And then last year, you can see on the very right-hand column, this time last year was about 53 days. So just over a month and a half, almost 2 months. And the list goes on and on there, but basically to wrap it up, supply is low, demand is high, interest rates are still low. So some of you out there might say, well, should I buy now, whether it's in Inland Empire, Orange County? Ron will kind of allude to some of this as he talks, but it's not is now the time, it's right now. So, again, appreciation is going up. You'll get that equity, and the forecast for the next 4 or 5 years is going to be dramatically in a positive manner. So with that, we can go ahead and move on to Ron.
Let me just one other thing there to kind of wrap this up and put a bow on it with Chrissy and Tyler both. Basically, as I indicated last month's webinar, nobody has been building any significant properties for the last 10 years. And so even if we started today building 24 hours a day for the next 5 years, they still wouldn't be caught up. So we have a long run as an investor getting in now before you're going to have more supply than you have demand. So you got a great opportunity to take advantage of that. That hasn't always been the case. Okay, has not always been the case. So and 3% interest rates has never been the case in all the time I've been in real estate, and that's been a couple of years. We'll leave it at that.
All right. So we don't have any other questions at the moment. So let's just roll into.
I think we have one. Hold on.
Oh, you do? Okay.
Someone asked, do you believe that the current administration will continue to keep the rates low, or will they raise them because of the threat of inflation? Personally, just what I've been gathering, I think that within the next 18 to 24 months, the interest rates might creep up. By how much, obviously, is to be determined. I don't think it's going to be drastic, but I do think because of the inflation that there will be a little bit of change. But I don't know if Ron, Chrissy, or Kristen, you three have any other insight on that.
I would concur with that. We're definitely going to see some inflation. How much, we don't know. But let's hope it's not what it was in the 80s. Okay, because that's what drove interest rates right through the roof. Okay, and I don't see that happening as far as that's the point. They keep a tighter lid on things today than they did, 30 years ago. So, okay.
So I also did see today there was a release that said that they were keeping interest rates low for the time being. And I think while there is the talk of inflation being transient or, temporary, that is the reason why interest rates are not going up the way that they would be adjusted if inflation was perceived to be more permanent. Mm-hmm. With that said, there is some data and some economists that are saying that by the end of next year, we should see 3.5% to 4% interest rate, because the strategy would be to actually slowly start increasing those to not create this red flag.
Right.
Okay.